Hi, this is Mike Larson for Money and Markets TV. Well, here we go again. The European Central Bank has been trying to paper over the sovereign debt crisis for months. But now it's clear that it's losing the battle in the PIIGS countries: Portugal, Ireland, Italy, Greece, and Spain. In just the past several days, the yield on Greek 10-year notes jumped to an all-time record of 17%. That compares to just 7.8% a year ago. Portuguese yields more than doubled to 9.7%, while the yields on Irish bonds hit a new crisis high of 10.8%. Moreover, the crisis is spreading more aggressively to larger European economies like Spain and Italy. The premium that investors demanded to hold Spanish bonds versus core German debt surged to a 4-month high, while Italian bond yields rose sharply as well. Standard & Poor's put Italy's A+ credit rating on negative watch, citing the country's slowing economic growth and large debt load, which now equals 120% of GDP. Meanwhile, the Socialist Party in Spain was routed in regional elections, raising concerns that the government won't be able to push through those unpopular austerity measures to reduce the country's budget deficit. We saw a similar run-up in yields on sovereign debt in the PIIGS nations more than a year ago. And at that time, European policymakers pushed through a massive $1.1 trillion bailout program designed to restore liquidity to the market for government bonds and give governments some breathing room. Then, the European Central Bank propped up failing European private banks by loaning them hundreds of billions of euros, using government debt as collateral. Now, those moves restored some liquidity to the bond market, but the problem isn't liquidity, it's solvency. The PIIGS countries simply borrowed and spent too much, and now they don't have the economic growth or tax revenue to pay those debts back at their full face value. The only real way out of this crisis is to restructure the debts and cut the value of government bonds. That would reduce the country's debt burdens and set the stage for long-term, healthy growth. But the ECB and hundreds of private banks are standing in the way of that plan, because it would cost them billions and billions of euros in losses. And that, in turn, would open up huge capital holes in the balance sheets of many banks and lead to outright failures. So instead, we get this game of extend and pretend. It lasts for a while until the crisis gets so severe that no amount of subterfuge can hold back the flood. Then, government bond prices tank, yields soar, and stock markets get hammered across the board. But this isn't just a European problem, folks. The US Federal Reserve has been playing the same game as the ECB. Many of its so-called solutions for the banking and housing sectors have been designed to restore liquidity, but they don't solve the real problem, that we borrowed and lent too much money against collateral that's still declining in value, namely houses, commercial real estate, and the like. So is it any wonder then that bank stocks are rolling over? That the shares of mortgage insurance companies, which make banks whole when borrowers default, are setting new cycle lows? Or that home prices are once again plumbing new depths in some markets and are dangerously close to doing so nationwide? Or that more and more signs are pointing to a slowdown in the US economy? The correct responses to these multiple crises are clear and straightforward. Take profits off the table on longer-term investments and target profits from downside moves in key sectors and asset classes. For Money and Markets TV, I'm Mike Larson. Thanks for watching.